Now, I would like to actually change some facts of illustration number 29, and I would actually like to show you how the accounting would actually change in such a case. In the question over here, the question mentioned that the holder is actually having an option to convert these preference shares into a fixed number of equity shares. Now, what would happen if the holder actually did not have an option, but actually the issuer had an option? What if Delimited had an option to choose between either issuing a fixed number of equity shares or actually redeeming it in the form of cash? All right. So, change number one that I'm doing is I am actually stating that instead of the holder having an option, the issuer is actually having an option to choose between issuing equity shares or actually paying cash. Also, the second change that I'm doing is instead of actually stating that this option is exercisable at any time over the next 3 years, I am actually stating that I'm actually changing the question to state that this option is exercisable at the end of the third year only. All right. So there are two changes that I'm doing. One change is I'm actually stating that the holder is actually not having the option, the issuer is having the option. And instead of saying that the issuer has an option to convert it at any point over the next 3 years, I am saying that the issuer has an option to choose only at the end of the third year. The delimited has an option to choose at the end of the third year whether it wants to issue equity shares or whether it wants to actually pay cash. Now, in this case, if you think of it from Delimited's point of view, Delimited has an obligation to pay a coupon of 6% for the next 3 years. Alright, Delimited will actually have an obligation to pay coupon for a period of next 3 years. Alright, so that is an obligation to pay cash. So with respect to coupon, there is a characteristic of a liability because Delimited has an obligation to pay cash to the holders of these preference shares. Now, if you think of it with respect to the principal amount or with respect to the maturity value, Delimited does not actually have an obligation because Delimited can actually avoid the payment of cash by issuing a fixed number of equity shares. Delimited can actually avoid paying cash by issuing fixed number of equity shares, and therefore Delimited is actually not having an obligation to pay cash. All right, Delimited has the ability to avoid the payment of cash by issuing shares, and therefore we are going to say that Delimited actually does not have an obligation to pay cash to the holders of the preference shares. All right, we over here, unlike the previous actual illustration number 29, the holder had an option, and if the holder exercises, Delimited does not have a choice. It has to actually pay cash. Whereas in this case, the choice is actually with Delimited. All right, the choice is with Delimited, and Delimited can actually avoid paying the cash. All right, because Delimited can avoid paying the cash, the principal payment does not have the characteristic of financial liability. It does not have the characteristic of financial liability because Delimited need not can avoid the payment of cash by issuing fixed number of equity shares, and hence we are saying that Delimited does not have an obligation to pay cash. All right, therefore, what this is also going to be classified as a compound financial instrument because it has the characteristics of both liability as well as equity. All right, so the conclusion is this is also going to be a compound financial instrument, but the change is going to be with regards to how the value of liability and equity will be calculated. All right, in actual illustration number 29, we calculated the amount of liability as the present value of the interest that we were required to pay and the present value of the principal that we were required to pay at the end of the third year. All right. Now over here, Delimited does not have an obligation to pay cash. It can avoid payment of cash. All right. Therefore, while we measure the liability, we will actually not take this 10 lakhs into consideration. The amount of liability will be measured as the present value of 60,000, which is required to be paid over the next 3 years. All right. Where Delimited can actually avoid the payment of cash, then we will not include the principal amount in calculating the liability value. All right, we're not going to consider the principal amount in calculating the amount of liability value, and the liability value will only be in such a case 1,51,878. All right, then equity value will obviously be the total amount of 10 lakhs minus 1,51,000, which would be approximately about 8,49,000. All right, so that is going to be change in the way we calculate the liability value and the equity value, all right, where the option to actually convert is existing with the issuer, then the issuer can actually avoid the payment of cash. The issuer has the ability to avoid the payment of cash, and therefore we are not going to consider the principal amount for the purpose of determining the liability. All right, for the purpose of determining the liability, only we have to actually take such obligations which the issuer cannot avoid, such obligations to pay in cash which the issuer cannot avoid. If the holder has the right, then the issuer cannot avoid the payment of cash. The issuer may be obligated to actually make the payment of cash if the holder has a right, but if the issuer himself if themselves have the right, then they can avoid the payment of cash by actually issuing shares, and therefore we are not going to consider the principal amount for the purpose of calculating the liability value. All right, so implicitly the liability value will only be equal to the present value of the coupon payments that are required to be paid over the next 3 years. The remaining will be classified as equity value. That is how the answer would actually change. Let's actually now summarize what we discussed. In the question that was given in the institute book, which I'm calling as 29.1, the holder had a right to exercise. The holder had a right to exercise, and the option to exercise was existing at any point during the next 3 years. It was existing at any time over the next 3 years. So, option to exercise was at any time over the next 3 years. Now, in this case, what we did was we calculated the liability value as the present value of the next 3 years coupon of 3 years coupon plus the redemption value. We also considered the redemption value to calculate the liability amount. We took the present value of the redemption amount as well to calculate the liability, and equity was basically a balancing figure. Equity was a balancing figure. Why did we consider the redemption amount? The reason we considered the redemption amount is because in this case, the holder has a right to choose, and if the holder chooses to exercise the payment of cash, then the entity D Limited does not have a choice to avoid the payment of cash. D Limited may be obligated to pay cash in future, and therefore we said that the redemption amount should also be included in the liability value. And equity value over here was a different balancing figure. In the next illustration that I created, which I'm calling as illustration 29.2, I changed the question to state that the issuer has an option. D Limited actually has an option, and the option to convert is at the end of third year. The option to choose is existing only at the end of third year. So at the end of third year, issuer or D Limited will choose whether it wants to pay cash or whether it wants to issue shares. So we heard D Limited is actually not having an obligation, it is having a right to choose. It is having a right to choose whether it wants to pay cash or whether it wants to issue equity shares. And therefore, over here we are saying that D Limited is not having an obligation. It can avoid the payment of cash because there is an alternative, and because it can avoid payment of cash, you cannot consider that as an obligation, and hence the liability value over here is going to be equal to present value of the 3 years coupon only. We are not going to take the redemption value over here, and equity will be a balancing figure, but this time the balancing figure will be higher. All right, the liability value is going to be lesser and the equity value will actually be higher in this case. This is illustration 29.2. Now let me create another illustration, another scenario, which I'm calling 29.3, where I will state that the issuer is still having an option. The option to convert is still with the issuer, but instead of keeping it at the end of third year, like 29.1, I'm going to give the option to convert at any time over the next 3 years. All right, so the issuer has an option, but the option is to convert it at any time over the next 3 years. The question is, how is the accounting actually going to change if the issuer has an option to convert it over the next 3 years? Now, what is going to happen in this scenario is basically, if over the next 3 years, if the issuer chooses or exercises the option, it will have to issue equity shares to the holders. If the issuer does not exercise the option, then at the end of third year, the issuer will actually have to pay cash. All right. So issuer has the right to actually have these converted into equity shares over the next 3 years. If at the end of third year, if the issuer has not exercised the option, then it will actually have to pay cash of 10 lakhs to the holders. This is how the transaction will actually work. The question is, how do we actually account for it? Now, if you think of it, over here, the issuer actually has a right to convert it over the next 3 years. It has a right to convert it at any point over the next 3 years. Let us say it converts it in month one itself. Let us say it converts it in month one itself. If you think of it, if it converts it in month one, it need not pay coupon for the first year, it need not pay coupon for the second year, and it also need not pay coupon for the third year, and there won't be any principal payment as well. All right. So if you actually think of it, where the option exists with the issuer to convert it at any point in time over the next 3 years, the issuer can actually avoid the payment of coupon also, and it can avoid the payment of the principal value. If the issuer has an option to convert it at any point over the next 3 years, the issuer can actually avoid payment of coupon as well. How can it avoid the payment of coupon? By actually choosing to convert it in the first month. Coupon is payable at the end of year one, end of year two, and end of year three. If the issuer chooses to convert it into equity shares at any time before year one, let us say it converts it in month one, on month two, or month 10, then it can actually avoid the payment of coupon for year one, year two, and year three, and it can also avoid the payment of redemption value. That was not the case in 29.2 because the issuer had the option only to convert it at the end of third year. So there was no chance that issuer could have avoided the payment of coupon. Issuer was obligated to make the payment of coupon, whereas in 29.3 illustration, the issuer can actually convert the equity shares at any point in the first year itself, and it can avoid the payment of cash to the holders for year 1, year 2, year 3, and year 4. And therefore, in this case, we are going to say that the issuer is actually not having an obligation to pay any cash at all. Issuer is not having an obligation to pay any cash because it has a right to actually avoid the payment. There can be a scenario where it can actually avoid the payment. It has a right to convert it into equity shares and therefore can avoid the payment of coupon. And hence, we are actually not going to classify this as a compound financial instrument. We are going to classify this as an equity instrument. All right. This is most likely going to be classified as an equity instrument because the issuer can actually avoid the payment of cash by converting it into equity shares. All right. So where the issuer has an option to convert it at any time, then it is not going to be classified as a compound financial instrument at all. In 29.1 and 29.2, we classified them as compound financial instruments. Whereas in 29.3, we are not going to classify this as a compound financial instrument itself. All right. So that is how the question will actually change if we actually state that the instead of the holder, the issuer has a right to convert, and also the answer would change depending on when the issuer actually has the right to convert. All right. So that is how the answer will actually change. Now we have an example in the institute material similar to the situation of 29.3. Let's actually take a look at that example. Let's look at illustration number 31. XYZ Limited issues optionally convertible debentures with the following terms. The debentures carry an interest rate of 7% per annum. The issuer has an option to either, remember, the issuer is having an option to convert the instrument into a fixed number of its own shares at any time. All right. So let us say instead of fixed number, I'm taking a number. So let us say the issuer actually has an option to issue 10,000 shares and get these bonds converted, get these debentures converted at any point in time. All right. The debentures have a tenor of 12 years. That's given later in the question. But what the question is saying is over the next 12 years, I as an issuer XYZ Limited has an option to actually get these converted into 10,000 fixed number of shares. Or the issuer also has an option to redeem the instrument in cash at any point in time. So over the next 12 years, XYZ Limited also has an option to actually pay cash and actually get these debentures nullified. All right. Yes, the maturity is 12 years, but there is also a prepayment sort of an option. It has an option to actually pay cash much before the 12th year, and therefore the debentures will then be settled. The redemption price, which is the redemption price, basically means the amount of cash that I will have to give is the fair value of the fixed number of shares into which the instrument would have converted if it had been converted. What they're saying is, if the issuer chooses to redeem the instrument in cash, the amount of cash that it will have to pay would be equal to 10,000 multiplied by fair value. How did I get 10,000? 10,000 is the number of shares that would have been issued, right? So 10,000 multiplied by the fair value per equity share will be the redemption price. All right. So the issuer has an option one to redeem these shares at a cash, or to actually redeem these debentures at a cash, or to convert the debentures into 10,000 shares. If it chooses to actually redeem the debentures for cash, it will have to pay 10,000 shares multiplied by fair value for per equity share. Whatever is that value, it will have to pay that some such an amount in the form of cash. That is what the question is saying. The holder has got no conversion or no redemption options. All right, so the holder has got no conversion or redemption options. The debentures have a tenor of 12 years, and if it is not converted or redeemed in the in earlier, it will be repaid in cash at maturity, including accrued interest, if any. All right, so if they're either not converted or redeemed in the next 12 years, at the end of 12th year, you actually have to pay cash, including accrued interest, if any. The question is, examine the nature of the financial instrument. In this question, just like 29.3, the issuer has an option to convert it into equity shares, and the conversion option is to convert it at any point in time over the next 12 years. So obviously, over here, the issuer has a right to actually avoid the payment of cash. It has an option to actually avoid the payment of cash by actually choosing to convert it into a fixed number of equity shares. If it chooses to convert it into equity shares, it can actually avoid the payment of cash, and therefore this will be regarded as a pure equity instrument. All right, this will be regarded as a pure equity instrument because the issuer can actually avoid the payment of coupon. It can avoid the payment of coupon by actually issuing shares. It can avoid the payment of coupon and the principal value by issuing shares. All right, it need not pay the interest of 7% if it chooses to actually convert the debentures in the very first year itself. Since it can avoid the payment of cash, it will not be classified as a financial liability, but will actually be classified as equity. Let's quickly go through the solution of the institute. The issuer has the ability to convert the debentures into a fixed number of its own shares at any time. The issuer therefore has the ability to avoid making a cash payment or settling the debentures in variable number of its own shares. It does not have an obligation to either make a cash payment or does not have an obligation to issue a variable number of equity shares. All right, it has the ability to avoid that. Therefore, such a financial instrument is likely to be classified as equity. I'm stressing on the word likely. All right. If you look at the word is likely to be classified as equity. Why is it likely to be classified as equity and not always going to be classified as equity? Let us actually continue reading. It must be noted that mere existence of a right to avoid the payment of cash is not conclusive. All right. What the standard is saying is, just because I have a right to avoid the payment of cash, don't blindly classify it as equity. The instrument is supposed to be accounted as per its substance, and hence it needs to be seen whether the conversion option is substantive or not. What does that mean? It means that the issuer will actually need to determine whether it is favorable to exercise the conversion option or redemption option. Where the issuer has conversion option and redemption option, the issuer should actually determine which of them is more favorable, whether the conversion option is more favorable or whether the redemption option is more favorable. In case of latter meaning redemption option, if the redemption option is more favorable, then the instrument will be classified as a financial liability. All right, so what they are saying is, just because you have an option to avoid the payment of cash, do not blindly classify it as equity. Do not blindly classify it as equity. Yes, there is a chance or it is likely that it is equity in nature, but still over here, because there is also a redemption option, evaluate whether if redemption option or equity conversion option, which of them is actually more favorable. If the redemption option is more favorable, then classify it as a liability. But if equity option is more favorable, then classify it as equity in nature. All right, then classify it as equity. So with that, we are done with illustration number 31.